And my next guest says that drop in yields reflects investors' fears the Fed will start tapering too early. And despite a 4% drop in the value ETF last week, he's sticking with his names there. Joining me now is Jim McDonald. He's the chief investment strategist at Northern Trust. His firm has more than $1.4 trillion in assets under management. Jim, it's good to have you. So I think you might be echoing some of the points that Mike just, started off this discussion with. So why are you confident that sticking with value is the way to position post-Fed?
Well, the death of the value trade would come when there is an expectation that the Fed is going to really hurt the cyclical recovery. And we don't think that's the case. The Fed is a couple of years away from raising interest rates. And value stocks right now have got much better earnings momentum, and they've got a valuation discount. Before this sell-off, they were trading at about a 33% discount to growth. They've gotten down to about 40% now. And we think better earnings growth and then some valuation expansion put some tailwind behind value.
So value stocks trading at a 40% discount to growth is pretty eye-popping. Have we ever been at these kinds of extremes before?
We have, but it's not been very frequent. And so it does really improve the odds. We're always thinking about things from a probability standpoint, and having that cushion in place absolutely gives you a better risk reward. Having said that, I don't want to say that we don't enjoy some ownership of growth stocks. In this environment, there's great fundamentals there on a long-term basis. Growth still looks good to us, but value really over the next 12 months we think will likely outperform.
It is very strange to look at what's happening in the bond market and with growth stocks because, here you have a Fed that's finally talking about inflation being a point higher than where it thought, all of these different things going on. That is not the end of this trade. It has given it kind of a new life, at least for the time being, right?
I think so. If you think about what the Fed is going to do from a timing standpoint, you have a situation where they have to prepare the markets for tapering. Then tapering goes on, and tapering probably lasts 9 to 12 months before they'll even consider any kind of a rate hike. So that really does get us into this 2023 timeframe. And the other thing, Kelly, is the short end of the fixed income markets, we think had priced in 2 hikes already before in 2023, before the most recent meeting. So that's why I think the market reaction was a bit overdone, and we're seeing some of the bounce back today.
Shepard Smith here. Thanks for watching CNBC on YouTube.